Yeah. Over to you, Rajesh bhai.
Okay. First and foremost, good evening. This is a very, very, monsoon weather in Goa. I didn't have the net and I was a little worried that whether I'll get it today or not. So far, so good. Although the basement is flooded and they have told us to remain, the gates are closed. So I'm here with you. And once again, thank you, Kanakji, for giving me an opportunity to share with you a book that I have read. I reread it again, rather I heard it again before this conversation. And the proposal that I have with me is for 5 minutes, I'll play the first intro of the audio so all of us can listen to it, because the way it is explained, the purpose of it, you will understand how important this book is for each and every one of us. We have to read this. This is the votary which I'm going to talk about. I've got some notes which I had earlier done a part of my course curriculum on this book. I will share with you after this talk. There are about 42 pages, so the summary of the book is there, highlighting. And at the end, I'll play the last 5 minutes where I feel it is the selling that counts. That's one of the most tough decisions. So I'll go about it and I'll make a beginning. So since the recording is there for those of who have joined a little later or something, it will be useful for them. Okay, so I shall share the screen and start my presentation. Can you all see it now? Yes. So it's called The Little Book That Builds Wealth, the Knockout Formula for Finding Great Investments by Pat Dorsey. Pat Dorsey was the investment research analyst at Morningstar. He has created, and this is one of the excellent books. It may be about 10 years old, 12 years old, but it still has its relevance. It may be a US related, but we can relate it to India also. And what I would like to do is, I'll play an introduction for about 5 minutes of this book. Just a moment. Please listen to this and let me know if it is clear.
Introduction. The game plan. There are lots of ways to make money in the stock market. You can play the Wall Street game, keep a sharp eye on trends, and try to guess which companies will beat earnings estimates each quarter. But you'll face quite a lot of competition. You can buy strong stocks with bullish chart patterns or super fast growth, but you'll run the risk that no buyers will emerge to take the shares off your hands at a higher price. You can buy dirt cheap stocks with little regard for the quality of the underlying business, but you'll have to balance the outsized returns in the stocks that bounce back with the losses in those that fade from existence. Or you can simply buy wonderful companies at reasonable prices and let those companies compound cash over long periods of time. Surprisingly, there aren't all that many money managers who follow this strategy, even though it's the one used by some of the world's most successful investors. Warren Buffett is the best known. The game plan you need to follow to implement this strategy is simple. 1. Identify businesses that can generate above average profits for many years. 2. Wait until the shares of those businesses trade for less than their intrinsic value and then buy. 3. Hold those shares until either the business deteriorates, the shares become overvalued, or you find a better investment. This holding period should be measured in years, not months. 4. Repeat as necessary. This little book audio is largely about the first step, finding wonderful businesses with long-term potential. If you can do this, you'll already be ahead of most investors. Later in the book, I'll give you some tips on valuing stocks as well as some guidance on when you want to sell a stock and move on to the next opportunity. Why is it so important to find businesses that can crank out high profits for many years? To answer this question, step back and think about the purpose of a company, which is to take investors' money and generate a return on it. Companies aren't really just big machines that take in capital, invest it in products or services, and either create more capital, good businesses, or spit out less capital than they took in, bad businesses. A company that can generate high returns on its capital for many years will compound wealth at a very prodigious clip. Companies that can do this are not common, however, because high returns on capital attract competitors like bees to honey. That's how capitalism works, after all. Money seeks the areas of highest expected return, which means that competition quickly arrives at the doorstep of a company with fat profits. So, in general, returns on capital.
Okay, friends, I thought the best introduction was to share the audio of the introduction of this. And going back to my presentation. Okay, so the entire book is on one word. It is called moat. See, I'm not going to explain and read because we all can read the book, but I just want to highlight that book discussion. So basically what he's trying to say in one sentence is simply buy wonderful companies at reasonable prices and let those companies compound cash over long periods of time. For example, on the Indianized version, I just took one company called Nestle. Now, where I come from, and by a show of hands, how many of you have read this book? Okay, no worries. I'm glad at least I'll introduce this book, and by the end of the session, we'll have a determination that all the 12 books that are going to be discussed, if we read them, will be enriched, and it's going to be a really an awesome experience. Okay, so coming to Nestle, what is very interesting about the moat, the concept is the company builds itself a moat around itself in such a way that it's very difficult for a competitor to come in. What I have done, I just checked on Nestle on these points. Can you believe that it has got 96.5% market share in Nestle Cerelac? Can you believe that all over India, children are born? Cerelac is a must or whatever. If tomorrow Kanak ji and me decide to start a baby food processing business, we'll get an outright rejection. Because the government will say mother's milk is the best milk. Sorry. So only Nestle, and you can buy this baby food in a pharmacy. It is not available in a general store. So imagine the pricing that Nestle has a command. Whether it is lactogen, this thing, then there is the food products, that is Maggi, the ketchup, the pasta, the Kit Kat, and of course the Nescafe. So this is where I look at it. Now, if you look at the pricing, 20-30 years back, Nestle was 500 rupees. Today it is 18,000 rupees. Last 3 years, almost it doubles every 3-4 years. It's not been a good report last 3 years. The sales have not grown up that much at 9%. But what I'm trying to tell you is that imagine if we have a product like Nestle, Pidilite, Asian Paints, somewhere who are Page Industries, the leaders. It is awesome. So this is the concept of this book. It is a no surprise advice. So that should be the bulk. That is what the book is trying to tell. Of course, it gives examples of Coke. It gives examples of the US-based companies in that. And the conclusion of this also, I would like to play an audio. Before that, I would just highlight in the chapter forms, which I'll be sharing with you also. That's why I'm saving on the time of reading. They talk of the economic moats and how it will help you to pick great stocks. It talks of mistaken moats, where don't be fooled by these illusory competitive advantages. You may think that a particular company has a competitive advantage, but if tomorrow, just because of the name, a competitor can come and price it a little lower, and people don't mind buying, let us say, in Kraft cheese in the US, any other cheese also is a cheese. So that might not sustain. And they talk of intangible assets, that is, you can't pull them off a shelf, but they sure are valuable. A brand creates an economic moat only if it increases the consumer's willingness to pay or increases customer captivity. Basically, what he says is that if you can find a company that can price like a monopoly without being regulated like one, you've probably found a company with a wide economic moat. For example, I was looking at Pidilite, because as it is, even a stationery shop has that 5 rupees ka Fevikwik, and the amount of business, and not only that, the way they have grown. If for my home repairs, Fixit was the best, it did not belong to Pidilite, they went and bought that company. If Araldite was good, they went and bought that company. So they have got 4-5 acquisitions, which are again integrated and ethically sound, good, and it's a case study in most of the management institutes. Constantly 25-30% CAGR year on year. Then they talk of switching costs. Sticky customers aren't messy, they are golden. So he gives an example. When is the last time you changed the banks? You know it for sure. Even if I feel that I'm having an account with a particular bank, for example, Axis Bank, and someone tells me, no, Kotak Bank is better. I might open an account with Kotak Bank, but I can't change from Axis Bank because of my whatever links, like if the dividends or payments and all are there. So that is also, as we call it, as a sticky, kind of the switching costs are going to be high. So look at those companies. Then of course he talks of a special chapter for network effect. So powerful, it gets a chapter to itself. So he talks of how in the Indian context, I looked at Bajaj Finance, I looked at the job seeker, that Naukri.com, how exactly some of these companies are doing. Then we talk of another chapter, he talks of cost advantages, get smart, get close, or be unique. So they matter the most in industries where price is a large portion of the customer's purchase criteria. Then another chapter is on bigger can be better if you know what you're doing. So a law firm with 1,000 lawyers has no cost advantage over a law firm with 10 lawyers. That's what he talks about. Then he talks of, see, what it means is, like, say, for example, an example he gives is, no, I have not had the screen. He gives us the Blackboard software allows the faculty to post assignments, helps the students to collaborate on projects, and enables faculty and students to communicate. But like industrial firms, there's not a mammoth market, so it's less likely to attract a giant like Microsoft or Adobe. See, remember one thing, less likely to attract such a giant. So that means sometimes that particular company is in a niche arena. And sometimes there are eroding moats. He talks of like, I've lost my advantage and I can't get up. He gives examples of 30 years back, 40 years back. Remember Polaroid, how it was revolutionizing the way the people took pictures, but the firm died a slow death before long before digital imaging put the final nail. Same thing, long distance telephony and newspapers. These are the examples. So finding moats is a jungle out there. Some industries are brutally competitive. And what he says, I'll just quote, is having awful economics and creating a competitive advantage requires the managerial equivalent of a Nobel Prize. So turning to asset management, let's talk of Morningstar covers 18 publicly traded asset managers, all of which have economic moats. In fact, it doesn't have wide moats while the rest have narrow moats. And finally, the last few chapters, they are called on management matters less than you think. He talks of where rubber meets the road, where 5 examples of competitive analysis he gives. And it's a little bit technical on EBITDA, looking at the technicals, but what is a moat worth? Even the best company will hurt your portfolio if you pay too much for it. Now, this is an example where sometimes if you buy a company at the peak, however good the company is, you might be ending up for 10 years without any returns. At times you have seen, say for example, Hindustan Lever, some time back for 10 years almost, there was no movement and suddenly it made up for the last 10 years. And the last is the tools for valuation, how to find stocks on sale. Last but not the least, what I like this last chapter 14 was when to sell. So this is the last 5 minutes I want to play it out, wherein, okay, let me here share the screen. Okay, basically, please listen to this audio. This was the crux of the whole book. So if you can hear, like, when to sell, some pointers I'll be sending it to you all the written down. I'll just put it on.
Line 1. If you have made a mistake analyzing the company and your original reason for buying is no longer valid, selling is likely to be your best option. 2. It would be great if solid companies never changed, but that's rarely the case. If the fundamentals of a company change permanently, not temporarily, for the worse, you may want to sell. 3. The best investors are always looking for the best places for their money. Selling a modestly undervalued stock to fund the purchase of a super cheap stock is a smart strategy. So is selling an overvalued stock and parking the proceeds in cash if there aren't any attractively priced stocks at the time. 4. Selling a stock when it becomes a huge part of your portfolio can make sense depending on your risk tolerance. Conclusion: more than numbers. I love the stock market. I don't love all the raving and ranting about job reports and Federal Reserve meetings, nor the breathless discussions of quarterly earnings reports minutes after they hit the news wires. Most of this is just noise anyway, and has little bearing on the long-term value of individual companies. I largely ignore it, and so should you. What does get me up in the morning is the opportunity to see how thousands of companies all try to solve the exact same problem. How do I make more money than my competitor across the street? Companies can create competitive advantages in a wide variety of ways, and seeing what separates the great from the merely good is an endlessly fascinating intellectual exercise. Of course, it can be financially rewarding as well, assuming you wait patiently for quality businesses to trade for less than their intrinsic value before making an investment. The key is to realize that you can let the companies in your portfolio do some of the heavy lifting for you in terms of investment returns. Companies with strong competitive advantages can regularly post returns on capital of 20+%, which is a rate of return that very few money managers can achieve over long periods of time. The opportunity to become part owner of enterprises that can compound capital at such a rate, especially if your ownership stakes are purchased for 80 cents on the dollar, has the potential to build a lot of wealth over time. One thing many people don't realize about investing is that it's not just a numbers game. You do need to understand some basic accounting to get the most out of financial statements. But I've known some pretty smart accountants who weren't much good at analyzing businesses or picking stocks. Understanding how cash flows through a company and how that process is reflected in the financial statements is necessary, but by no means sufficient. To be a truly good investor, you need to read widely. The major business press, the Wall Street Journal, Fortune, Barron's, is a good start, because it helps you to expand your mental database of companies. The more companies you are familiar with, the easier it will be to make comparisons, find patterns, and see themes that strengthen or weaken competitive advantages. I would argue strongly that reading about companies will add infinitely more value to your investment process than will reading about short-term market movements, macroeconomic trends, or interest rate forecasts. One annual report is worth 10 speeches by a Federal Reserve chairman. Once you've made these publications part of your investment diet, move on to books about and by successful money managers. There's no substitute for learning about investing from people who have practiced it successfully, after all. Quarterly shareholder letters are valuable for the same reason, and they have the added benefit of being free. In my opinion, the quarterly letters written by solid money managers about their portfolios are some of the most underused investment resources on the planet. And given the price, they are certainly worth more than you're paying for them. Finally, there is a burgeoning literature about how people make investment decisions and why that process is often filled with hidden biases. Books like Why Smart People Make Big Money Mistakes and How to Correct Them by Gary Belsky and Thomas Gilovich, Simon & Schuster, 1999, The Halo Effect by Phil Rosenzweig, Simon & Schuster, 2007, and Your Money in Your Brain by Jason Zweig, Simon & Schuster, 2007, will help you see the flaws in your own decision-making.
So friends, what I learned from this is that he talks of suggests us to read the papers. Let's see, last 15-20 years, I have been reading the Wall Street Journal. Believe it, some articles of the Wall Street Journal are so effective that you can align it. Of course, sometimes they're a little plus minus, they're anti-India or whatever, that's another story. I mean, you remove that out of it. But the information that you get from the Indian point of view, I like the mutual fund fact sheets. Sometimes, Navneet Munot's annual letter, sometimes the annual report, what he talks of, whatever, read the annual report of a Wipro or something, it is all available online. Okay. Then the quarterly letters, it could be by the Oak Tree chairman, and these are the things, Morgan Housel, sometimes the collaborative fund. Read all of them, whatever you can. It will help us in developing ourselves into better volatility coaches. So now almost 2:30, so I would like to stop here, and I hope the style of my presentation, Kanakji, because I didn't want to repeat. I said let first 5 minutes and last 5 minutes of the audiobook. Audible is a very nice app. You can, I got this, if you subscribe, you get for 199 rupees every month, you can download. So I had the physical book. Now the physical book is costing almost 2,000 rupees, but the Audible audiobook is costing 199 a month. When you subscribe to that and you can download. So this is what I had to share with you. Over to you, Kanakji. Thanks once again for giving me an opportunity, because it made me read again, and I realized it improved my perspective once again. Thank you.
Thank you so much, friends. I think any question on this, you can just ask maybe for another 2 to 3 minutes. Then we will have Varun. Any questions? If there is, you can write it in the chat box also. But this is really a big value to all of us, because if it's a big fat book, okay, some other books like of Tony Robbins also coming up in the coming weeks, there are so fat books. Even a person like me who also reads, but when you look at 1,000 page, 2,000 page, you just feel like so if you get a summary like this, I think that's really helpful. So,
and I've sent the summary in the group also, the 42 page, the pointers I've sent.